Today we have with us Arkadiusz Sieroń. Eric is a professor of economics, and he is also the author of SunshineProfts Monthly Gold Overview. Thank you for joining us today, Eric.
Hi, thanks for having me.
You're welcome. Thanks for joining. Considering recent numbers, there is no doubt that the market is really spooked by inflation fears. Are these fears justified, and why?
Indeed, yes. The market expectations of inflation have risen recently, and I believe strongly that rightly so. You can see the rising prices almost everywhere, especially in the commodities, in the housing market as well. So, and the producers, we hear this a lot of complaining, and we can read it in a lot of reports that producers are passing on the rising input costs to the consumers. And last but not least, the CPI, annual inflation rate, has jumped 4 to 2% in April, which indicates quite strong inflationary pressure indeed.
What other factors besides this never-ending printing of fiat currency are contributing to this inflation?
Oh, that's excellent question. And of course, there are many factors. The increase in the broad money supply is the key factor, of course, but there are others too. First of all, the Fed and the government, they injected a lot of money into the real sector now. I mean here that during the Great Recession, so after the previous crisis, the new money entered the economy through the financial sector. Okay, the central bank and the government, they provided funds to the banks and big companies. They were bailouts of the banks and car producers. But now this situation is quite different because many Americans have got checks and they are ready to spend all this money, all this accumulated funds and savings. So the realization of this pent-up demand could add to the inflationary pressure. And another thing, maybe more long-term issue, is the enormous increase in the public debt. So the government could be interested in the monetization of this debt and some kind of financial repression, which could also add some pressure on the Fed to remain ultra dovish and let inflation increase.
As a hedge against inflation, I purchase gold. Tying inflation to gold, could you just give us your opinion on the short, intermediate, and long-term view on the price of gold, and
Of
why?
course, yes. I'm in the long term, I'm definitely bullish on gold because I see the current monetary system based on fiat money and fractional reserve banking as inherently unstable. Okay, and our economic model based on debt and low interest rate is also inherently unstable. This is why I'm bullish on gold in the long term. But given the recent rebound in gold in May, I'm also quite optimistic about gold in the shorter term. It seems that the market euphoria about the economic recovery has already peaked. So I mean here that the negative sentiment toward gold has also already peaked. The price of gold has already jumped above 1800s, and I think there is room for further gains. However, in the medium term, I see some risk because I'm afraid that we could see a replay from 2019 and 2013 when the Fed started tightening its monetary policy. Again, when the Fed starts tightening its monetary policy, or when the long-term interest rates rise, gold could enter the bear market. However, there are still a few or maybe even several more months before an action. And just yesterday, the Fed published its recent minutes from its last meeting. So the Fed reaffirmed us that it will remain very dovish and behind the inflation curve. So I believe that gold can gain in the next few months.
Whether you're trading or investing in gold in its physical form or derivatives or ETFs, what are some of the most important things that a person should be considering or looking at when investing or trading gold?
Yeah, that's a very good question. And of course, there are many important factors in the gold market as it's really complex market. But so one issue is the market sentiment I mentioned earlier. However, I would say that the most important thing is the real interest rates. They're a key driver as they set the opportunity cost of holding gold. There is also the US dollar, its strength. It's also very important factor as usually gold and the US dollar are negatively correlated. And last but not least, the level of confidence in the Fed and more generally in the economy, in the financial sector, is also crucial to look at when considering an investment in gold. It's because many investors buy gold when they have no confidence in the Fed, in the US dollar, in the economy. So this risk appetite is also very important factor.
Well, thank you, Eric. Thank you. If someone were interested to learn more about your opinions on gold and inflation, where could we find you on the internet?
You can find me and my articles at SunshineProfits.com.
So that's www.sunshineprofits.com, correct?
Exactly. Yes, that's correct.
Thank you for joining us today, Eric.
Thanks for having me. Bye.